Picture this. You walk into a hotel lobby at 11 p.m. There are maybe 6 guests checked in on that floor. The lights are on in every hallway. The pool is heated. The front desk clerk is standing there, paid whether anyone walks up to that counter or not. And somewhere in the basement, a boiler is running hot water to 200 rooms, even though 140 of them are sitting completely empty tonight. That building is still losing money the second the sun sets, whether a single guest checks in or not. And that right there is the part almost nobody understands about the hotel business before they buy one. You are not selling rooms. You are selling something that disappears forever, if it doesn't sell tonight. A hotel room that goes unsold on a Tuesday isn't inventory. You can sell on Wednesday for double. It's just gone forever. And yet this is one of the only businesses on earth where a 5-star property can pull in $1,000 a night per room, while a budget Motel 2 exits down the highway is fighting over $40 guests, and both of them can end the year profitable. Or both of them can end the year bankrupt, depending on exactly one number that most owners don't even calculate correctly until it's too late. So today we're taking this industry apart. What it actually costs to build a hotel in 2026, and the number might genuinely shock you. Where the real profit hides, and why it's almost never where you'd guess. The one metric that separates a hotel that thrives from one that quietly bleeds cash for a decade. And the mistake, a very specific, very common mistake that has bankrupted more hotel owners than bad weather, bad reviews, and bad locations combined. Let's start with the language of this business, because if you don't understand this one term, nothing else in this video will make sense. It's called RevPAR, revenue per available room. And here's the formula. You take your occupancy rate, multiply it by your average daily rate, and that number tells you almost everything about whether a hotel is healthy or dying. Here's why it matters so much more than in most businesses. In 2025, the average daily rate for us hotels sat around $159, while national occupancy hovered around 63 to 64%. That's actually below pre-pandemic levels, which used to run closer to 66%. And that gap matters enormously, because almost all of a hotel's costs are fixed. The housekeeping staff, the mortgage, the property taxes, the insurance, none of that changes much, whether you're at 40% occupancy or 90% occupancy. Which means every single point of occupancy above your break-even level flows almost straight to profit. And every point below it is a direct hit to your bottom line. This is why RevPAR obsesses hotel owners, the way user growth obsesses tech founders. It's the one number that captures both how well you're pricing your rooms and how well you're filling them. But here's the trap, and it's a trap that catches new owners constantly. RevPAR only tells you about room revenue. It says absolutely nothing about what it costs you to generate that revenue. You can have a hotel with fantastic RevPAR and still be losing money, because you cut rates too aggressively to fill rooms. Or you're paying an OTA a huge commission for every single one of those bookings. Which is exactly why the real professionals in this industry track a second number, GOPPAR, gross operating profit per available room, because that's the number that actually tells you what's left after the bills are paid. In 2025, that industry benchmark sat around $80 to $85 per room for the average US hotel, with luxury properties pushing past $200. If your GOPPAR is falling further behind your RevPAR growth, that's not a market problem. That's a cost problem hiding inside a revenue number that looks fine. All right, numbers explained. Now let's talk about what you're actually buying, because hotel is an enormous umbrella, and the version you pick determines almost everything else in this video. Category 1. Economy and limited. Service. Think roadside motels, budget chains near highway exits, no restaurant, minimal amenities, small staff. Construction cost sits around $75,000 to $150,000 per room, and according to the HVS 2025 Development Cost Survey, the median for this tier lands right around $167,000 per key. A small 2-story motel might run you around $7 to $7.5 million total. The advantage here is brutal simplicity, low staffing, low overhead, and profit margins that can actually run higher on a percentage basis than fancier properties. Sometimes 5 to 15% net, because there is so little to go wrong operationally. Category 2. Mid-scale and select. Service. This is your Hampton Inn, your Holiday Inn Express, a small breakfast area, maybe a pool, a fitness room, but no full restaurant or banquet space. Development cost here runs $150,000 to $250,000 per room, with HVS pegging the median around $170,000 to $223,000 per key depending on exactly how select the service level is. Here's what's interesting. Data from the industry's Q3 2025 profitability report found that upper mid-scale and upscale hotels are actually posting the strongest GOP margins in the entire industry right now, outperforming both luxury and independent properties, despite charging noticeably less per night. Less glamour, tighter operations, better math. Category 3. Boutique and full-service hotels. Independent character properties, or full-service brand hotels with an on-site restaurant, meeting space, maybe a small spa. Construction costs jump significantly. Here $400,000 per room is the HVS median for full service, and boutique properties can push into similar territory or higher because of custom design and bespoke finishes. The appeal is pricing power and multiple revenue streams beyond just the room, which we'll dig into shortly, but the operational complexity and the payroll that comes with it jumps just as fast as the construction cost did. Category 4. Luxury and resort properties. Four Seasons, Ritz-Carlton tier, spas, multiple restaurants, banquet halls, extensive grounds, and enormous staff-to-guest ratio. And here's the number that should genuinely stop you in your tracks. The median cost to develop a luxury hotel in 2025 was over $1 million per key, and HVS specifically flagged a growing number of luxury developments where all-in costs exceeded $2 million per room. Let that sink in for a second. $2 million for one single hotel room, before it has ever hosted a single guest. There is actually a piece of napkin math that HVS's own managing director uses to explain why this is so brutally difficult to pull off. If it costs you $1 million per room to build, and you're running at a typical luxury occupancy of around 65%, you basically need an average daily rate approaching $1,000 a night just to make the numbers pencil out reasonably. And luxury ADAG nationally, even after recent increases, is sitting closer to $394. That gap is exactly why so few true luxury projects break ground every year, and why almost none of them get built without either a residence sales component bolted onto the project, or a developer with genuinely deep pockets and a long-time horizon. 4 completely different businesses, 4 completely different capital requirements, and 4 completely different paths to actual profit. Pick based on your budget and your market, not based on which one you'd most enjoy staying in yourself. Now here's the part most first-time hotel owners get wrong. They assume the room rate is the business. It's the foundation, sure, but the real profit conversation has at least 4 more layers on top of it. Stream 1. Room revenue. This is RevPAR in action, occupancy times rate. For most limited and select service hotels, this is the overwhelming majority of total revenue, often 85 to 95% of everything coming in the door. Stream 2. Food and beverage. The moment you add a restaurant, bar, or room service, you unlock what the industry calls TRevPAR, total revenue per available room, which captures everything a guest spends, not just the bed they slept in. For full service and boutique properties, F&B can meaningfully move total revenue, sometimes representing 15 to 25% of everything the property brings in. Stream 3. Meetings, events, and group business. This is the segment that recovered slowest after the pandemic, but it's also come roaring back. Group business made up roughly 22 to 25% of U.S. hotel revenue by 2025, up from the depressed pandemic years, compared to transient. Individual bookings holding steady around 65 to 70%. Here's why owners obsess over this segment specifically. Group bookings happen 12 to 18 months in advance. So the pace of group bookings today is basically a forward-looking signal of what your RevPAR is going to look like a year or two from now. It's one of the only pieces of this business where you can actually see the future coming. Stream 4. Ancillary revenue. Parking, spa, resort fees. Individually small, but they stack. Parking revenue in a dense urban property, spa treatments, resort fees that have become almost standard at leisure properties. All of it flows into that TRevPAR number, and at true resort properties, this category alone can be a meaningful slice of total income. Stream 5. Loyalty programs. The quiet financial engine. This is the one almost nobody outside the industry thinks about, and it might be the most important one on this entire list. Hilton Honors and Marriott Bonvoy each carry over 200 million members. That's not a marketing gimmick, that's a direct weapon against the single biggest threat to hotel profitability, which is online travel agencies. Here's the math that explains why. OTAs like Booking.com and Expedia typically take a commission of 15 to 25% on every single booking that comes through their platform. A direct booking, through your own website or loyalty program, costs you closer to 5%. At the scale major hotel brands operate, every single percentage point you can shift from OTA bookings to direct bookings is worth an estimated $50 to $80 million in contribution margin, system-wide. That's why the giant chains are so aggressive about pushing their apps and their loyalty numbers. A loyal direct booking guest isn't just a nice to have. They're worth roughly 3 to 5 times more in pure margin than the exact same guest booking the exact same room through a third-party site. Here's the pattern that separates thriving hotels from struggling ones. The properties barely surviving are almost always leaning hard on one thing: room rate, and usually room rate sold at a discount through an OTA. The properties actually printing money are running all 5 of these streams simultaneously, and fighting guest by guest to keep bookings direct, instead of handing away a quarter of the revenue before it even reaches their account. Now let's talk about where all of that revenue actually goes, because in this industry, the gap between gross revenue and what an owner keeps is enormous, and it surprises almost everyone the first time they see the real numbers. Labor: this is, without question, the single biggest expense category in the entire hotel business. Housekeeping, front desk, maintenance, food and beverage staff, and the industry has been dealing with a genuine labor scarcity problem in recent years, competing for the same workforce as restaurants and retail. Wages have climbed across the sector, and staffing shortages, specifically in housekeeping and F&B, have been constraining operations at properties nationwide. On average, sole proprietor hotel operations spend around 12% of revenue on salaries and wages alone, and that number climbs significantly higher once you include benefits, management, and outsourced staffing agencies that many properties now rely on just to keep rooms cleaned on time. Property costs: mortgage or lease payments, property taxes, insurance, and capital reserves for future renovations. This is a fixed cost category almost regardless of how many guests you have tonight, which loops right back to why occupancy is such a brutal lever. The building costs roughly the same to operate at 40% full as it does at 90% full. Distribution costs: this is the OTA commission problem we just talked about, and it deserves its own line item because of how much it can quietly eat. 15 to 25% of a booking's value, gone before you've even turned on the lights in that room, versus roughly 5% if that same guest had booked directly. Utilities and maintenance: hot water, HVAC, lighting, elevators, pool heating running 24 hours a day, every day, whether the building is full or nearly empty. On average, hotels spend around 7% of revenue on utilities alone, and another 5% on ongoing property repairs, and that's before you get into major capital renovations. Food and beverage costs: if you're running a restaurant or bar on site, material costs for food, drinks, and supplies can run around 13% of total revenue for a property with F&B operations. Though this line item obviously doesn't apply to a limited service property with no kitchen. Interest and financing costs: hotels are debt-heavy assets by nature, given how capital-intensive construction is. Sole proprietor data shows interest expense averaging around 7% of revenue historically, and given how much interest rates have moved in recent years, that number is very likely running higher today for anyone financing a new build or refinancing an existing property. Now here's the number that genuinely surprises people the first time they see it. When you add every single one of these categories together, the average net profit margin for hotel businesses, according to sole proprietor tax data, comes out to roughly -2%. Not a typo. Negative. Before you close this video in horror, there is an important asterisk here. Once you add back depreciation, which is a non-cash accounting expense running around 12% of revenue, that losses turns into a genuinely positive cash flow position, roughly 10% of revenue, landing in the owner's pocket in real terms. And on top of that, real estate appreciation on the physical property itself is a return that never shows up on that profit and loss statement at all. This is exactly why hotel investors think less like restaurant owners, and more like real estate investors who happen to run a business on top of their asset. The accounting profit and the actual wealth being built are two very different numbers. So let's put real percentages on this, because margin varies enormously by the category you picked back in section 2. Luxury hotels, when they work, post the strongest margins in the entire industry, 25 to 35% net, and industry-wide GOP margins across the sector held around 37.7% through the first 3 quarters of 2025. even in a softer revenue year, because operators leaned hard on cost discipline to protect the bottom line. Mid-scale hotels typically run 10 to 20% net margin, the segment that data shows currently, posting some of the best GOP performance in the industry relative to their ADR. Precisely because their cost structure is so much leaner than full-service or luxury properties. Budget and economy hotels post the widest range 5 to 15%, heavily dependent on occupancy discipline, because there is so little pricing power to fall back on if demand softens. As for the honest, unglamorous middle ground that most industry sources converge on, a good hotel profit margin generally sits somewhere between 15 and 20%, with anything above 20% considered genuinely strong performance in this business. Now for the timeline, because this is where a lot of first-time owners get blindsided. Even in reasonably favorable conditions, most hotel projects need 8 to 12 years to reach full break-even on the original construction investment, once financing costs, market conditions, and realistic ramp-up periods are factored in. This is not a business where you recoup your investment in year 2 or 3. It's a long, patient, capital-intensive game, and the owners who succeed are the ones who go in already understanding that timeline, rather than discovering it the hard way 3 years into a construction loan. Seasonality and demand swings hit harder here than almost any other business. Because your costs are fixed, and your inventory expires nightly, a slow month doesn't just mean lower revenue. It means a huge chunk of your fixed cost base runs with nothing behind it. A restaurant can at least trim food orders in a slow week. A hotel still has to heat every room, whether it's occupied or not. Labor scarcity is a growing structural problem, not a temporary one. Housekeeping and F&B staffing shortages have been a persistent theme across the industry, and every hotel is now competing for the same limited labor pool as restaurants, retail, and every other service business in town. OTA dependency can quietly strangle your margins, even while your revenue looks great. A hotel can show fantastic occupancy and a rising RevPAR while its actual profit slowly bleeds out, purely because too much of that volume is coming through platforms, taking a quarter of every booking. Revenue growth and profit growth are not the same story. And this is exactly where they split apart. Renovation and brand standard costs are relentless if you're flying a franchise flag. Major hotel brands require periodic property improvement plans, full refreshes of furniture, fixtures, and finishes on a set cycle, and those aren't optional if you want to keep the brand name and the loyalty program bookings that come with it. Economic sensitivity cuts both ways. Hard. Business and convention travel dries up fastest in a downturn, hitting full service and urban properties first. Leisure travel can hold up a little longer, but discretionary vacation spending is exactly the kind of expense households cut first when money gets tight. And competition now includes an entire parallel industry that didn't meaningfully exist 20 years ago: short-term rental platforms, competing directly for the same leisure travelers, often with lower price points and more space. Particularly in markets where a family might choose a whole apartment over 2 separate hotel rooms. But if you go in understanding exactly what this industry actually is: a fixed cost, perishable inventory business, where your entire fate rides on one number, RevPAR, and where the real profit hides in loyalty programs and direct bookings, rather than the room rate on the sign out front, the math absolutely can work. Pick the category that fits your capital and your market. Build every revenue stream you can stack on top of the room. Fight for direct bookings like your margin depends on it, because it genuinely does. And go in with a timeline, measured in years, not quarters.